Here's how you can be a multi-billionaire. As a disclaimer, none of what we say should be taken as financial advice. This is purely educational.
Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it.
Okay, MJ.
Yes.
So this is actually a Twitter thread by...
This is a summary,
yeah,
right?
This is a summary by Thomas Chua. Thank you so much, Thomas Chua, for actually...
Thomas is a friend of mine.
Yes.
She just visited him about a month ago. But yeah, so, you guys can go follow the Twitter account.
Yes.
But he very nicely summarized
the entire newsletter of the Berkshire Hathaway's annual report. And then also what is Warren Buffett's chairman statement. And all.
Yes. Also, by the way, guys, probably the most important book you can ever read on investing. Ironically, it's not something like Intelligent Investor. And it may not even be something like Peter Lynch's One Out of Wall Street. It's actually Warren Buffett's shareholder letters, and you can actually buy these books online where they compile it. Now, of course, you don't have to buy the book. You can actually just go to Berkshire's website and just download each of the PDF and read. But of course, if you're a bit lazy, then you can always buy the book.
Yes.
Okay. But yeah, so Thomas has summarized all this.
Yes. Okay. So the number one point, which is also something that we preach a lot also, which is Moat. It's never stagnant.
Yes.
So basically what Moat is your competitive advantage against your peers. And then of course you want a moat that is very durable.
Yes.
And it doesn't really shrink.
Right.
Yeah, just it's just as simple as that only.
Yeah, so we talk a lot about this in our SIB program actually. And to give you an example, right, of how not all moats are created equal. So the example I'll give is like alcohol, right? So before, alcohol was, like in Malaysia, Carlsberg, Heineken and all that, they were a lot more dominant.
Yep.
Right? Because to promote their products, you had to pay a lot of money, right?
Yeah.
Like they had to pay a lot of money. So maybe put it on a football shirt or maybe TV advertisements. But then with the advent of like Facebook marketing and digital marketing, brands who are just starting out wanting to do their own version of alcohol can just come up and start doing marketing and
Yeah.
This is how the moat has This is how the moat has shrunk.
Yeah. I know. Just to share a little bit, I remember the 90s, right? The 90s calendar.
Yes.
I remember they put they advertised their alcohol products on calendars.
Yes.
So it's actually pretty funny.
Exactly.
Time
There's actually those Chinese calendars.
Yes, right? Yeah. Okay, so number 2 is about commodity business. Now, this is actually pretty interesting because commodity business basically are businesses that don't really have moat.
Yeah.
Or maybe they have, but it's a very small one.
Yeah. But Buffett has used this quite a lot. Right? Yeah, he uses it from the perspective of a business owner.
Yeah.
Where he say, look, you don't know your business is good or not. Is this? Do you pray to like different thousands of gods before you lower your price of your products or service? If you have to pray very, very hard to do that, you have a commodity business.
Yep, exactly. So yeah, nothing much to comment on that.
Yes.
And I mean, one of the example we can give here is just glove.
Yes.
Yeah.
Now the flip side to this and linking up to point number 1, and you can see, right, all his points are connected. Yeah. And that is, if you are in a commodity business, therefore you have to find a moat typically where your cost is the lowest.
Yeah, correct.
So if you're in a commodity, like literally commodities, oil and gas, whatever, if your cost is the lowest, you have the advantage.
Yep. Okay, so the third one is the flywheel effect. This one is basically like it's okay. So remember, just visualize that there's like a circle over here.
Yes.
How I actually get to understand about this term is basically your advertisement.
Yes.
So how do I explain that? It's basically when you advertise something, that's where you get more eyeballs.
No, the eyeballs come first.
Oh, the eyeballs come
first. So you do
something,
whatever that something is, who knows, right? It could be a important sports match. It could be a social media platform. It could be the fact that you are in a very busy train station. Basically, where there is a lot of people congregating, that's when advertisements will become more attractive.
Yes. No, of course I remember there's a graph, right? They say you spend on advertisement, then there's eyeball, then there's more advertisers,
Correct.
and then advertisers spend more on the ads, and then it goes back again. So it's like a circle.
Correct. But before that first step, you have to decide where you want to put your first dollar first. So then once you decide where you put your first dollar, that's when you create that flywheel that you described, right? Now, of course, it's important to know there's also a reverse flywheel.
Yeah.
Right, where everything, turns to...
Yeah, down. Yeah, but this kind of business actually heavily applies during back in Buffett days where newspaper is the big thing.
Yep.
Yeah. Back then when we have newspaper, now we have like apps like Facebook, where you get your news is from Twitter, from all these. I mean,
classic is the App Store, right?
Yes.
Everyone wants to be there because that's what everybody uses.
Yeah.
So then, because that's what everybody uses, they pump in more apps available. Then when other people go into the app, they're like, yeah, this is the App Store is great. So then more people come in, more apps come in, more people come in. So that's how you do it.
Yes, sir. Okay, so the fourth one is operating leverage. This have to do with a lot of fixed costs and also your low variable costs. So if let's say a company that have a very high fixed cost but low variable cost, right, you can actually see the bottom line to be rising much faster than your revenue. But also it can be a disaster when your revenue is declining. So
the way to understand this is there are some companies that you have to pump in a lot of money at the beginning, and then you reap the rewards later on. So an example might be, let's say, a restaurant. I always like to go by restaurant because it's the easiest to explain. But let's say you have like some fancy equipments that in your assessment don't need much maintenance, because if you spend it right now, then in the future you don't have to spend much. So maybe at the beginning when you're starting out the business, like your restaurant is only like a quarter full, half full. So that's where scale comes in, and you are working towards it being full.
Yep.
So once that's full, then that machine, the cost is still more or less the same, but then you're selling more bowls of noodles. Then you can raise prices on those bowls of noodles. And so then that's where, operating leverage comes in. And of course, the aggressive version will be, let's say if that machine cannot just support one restaurant, it can support several. So then you really get that, what we call operating leverage. But of course, it definitely cuts both ways. Like if you don't have a product that actually sells well, then that is a very expensive waste of equipment.
Yes, correct. Or another example is the media business, like what we're doing right now also. Yeah.
Yes, our cameras.
Yeah, the cameras and all the equipments.
Yes.
Okay, so the fifth one is about the fundamental of investing. I think we highlighted this quite a lot of times already.
Yes.
So it is your typical know your own circle of competence. Of course, you don't want to look at the price charts and you speculate on the price movements, and also you want to focus on future cash flow. The fourth point maybe you have a different view.
No, I think where I read Buffett enough to know that when he mentions macro, what he is saying is the rubbish. So what is the GDP gonna be in next quarter? What is how much is the interest rate gonna go up by? Right. So that's the popular version of macro, which is absolutely true. It's mostly a waste of time, right? But there's another version of macro which is a lot deeper, and it that has a lot to do with actually finding trade ideas. But it's a completely different thing.
But I think you highlighted this a lot in FIRL Pro.
Yes,
in the big picture report. So the links to the free sample.
So I agree with Buffett that it is a waste of time, right? Looking at the news, especially the key is the news. You really can't learn a lot from the news.
Yeah. And the last one is just ignore volatility as usual. Okay, so the sixth one is about Mr. Market.
Yes.
Basically, Mr. Market is just here to serve you. It's not here to guide you whether the price is going at this level or at that level. So you just need to know that you don't be emotional when you are doing this kind of investing, especially in the stock market when everything is pretty much irrational in the short term. You don't know where is it moving. Yeah. But in the long term, if let's say you know what you're buying into, you know your companies very well, you know the business very well, eventually, if your analysis is right, it will definitely pay off in the future. Yeah,
that's why you need to do your homework. And the way the market should be is so one of the things to put this into real practice is that I tend to not like to think about trading or make trades when the trading hours are open.
Yep.
So I like to do it when it's quiet, because if you interact with Mr. Market when it's awake, it messes with your psychology, right? You think you put this price and it dropped 2%. Oh no, okay, I'm gonna wait, you know. Or it goes up. You jump, you wait for it to drop. So, things like that. So the way you think about it, imagine if you prepare and you do your work already, and you think this company is worth this amount, then you just go into the market and says, I think this company is worth $5 a share that, now it's trading at $7. Okay, ignore, next. And then, maybe 2 weeks later, you look at it. Now it's $4. Okay, maybe it starts to get interesting. So that's how you should treat like the market, Mr. Market. But you shouldn't be looking at the screen and let Mr. Market, instruct you what to do and all that. It's just, Mr. Market feed you information, I'll do this. Again, it's there to serve you, not to guide you.
Yes. Okay. What is risk? Okay, so basically, also the same thing, it does not really come from a price volatility. And also, it could be managed away by simply diversifying. Even though, let's say you diversify into 10 penny stocks, right? You still, your returns most likely.
If you diversify into rubbish, you get rubbish. Yeah.
Yes, exactly. So, and also actually, just to summarize, the risk is actually your permanent loss of capital. Just put it that way.
Yeah, and so what it really means is like how likely are you to lose that money?
Yeah.
And that is risk, basically. Not how the stock yo-yos.
Yes. Okay, so growth versus value investing. Now, this is also something that we highlighted a lot. If you think that stocks with low price to earnings ratio, price to book ratio, or even high dividend yield is a value stock, is actually a bad thinking.
Yes.
Yeah. And of course, the reverse is true. If let's say you think if it's high PE, it doesn't mean it's overvalued. Sometimes a high PE stocks could mean it's undervalued.
Yeah.
Yeah. You never know. Yeah. That's why knowing about the business, the industry dynamic is very important before even talking about these valuation metrics. Yeah. Anything?
Yeah, that's true. And in fact, to extend, I know Warren Buffett knows that this distinction between growth and value is a bit imaginary, meaning like, growth is part of value, right? When you value something, don't you assess the growth also?
Yep.
Right? If you're thinking, let's say, to work with this business partner, and the business partner have no intentions to grow, why would you put value to the business partnership? So this distinction is, marketing is easy for people to understand, but it's an oversimplification of investing.
Yeah.
Because again, growth is part of value.
Yes, correct. And he also ended up with this. Basically, you need to focus the return on capital versus the cost of capital.
As simple as that.
Yeah. Okay, so we are halfway through there. Number 9 is the durable businesses. Also something like Moat. Yeah, and the example that he gave over here is basically Jeff Bezos, similar to him. Buffett only focus on what doesn't change for a business.
Yeah.
I mean, his business is pretty much very simple business model, businesses that he can understand. And yeah, that's how he actually reap a lot of high returns.
Yeah, this is very different, right, from a lot of investors. A lot of investors want to see what the big changes.
The next big thing.
Big changes. Things like that. Where Buffett's coming from is, okay, what won't change in this company? Okay, he go and figure out 3 things. Those 3 things, if it doesn't change, will it be good for the company? Yes, then okay, is it undervalued? Undervalued, buy. If these things are not good, if it doesn't change, then he will quit.
Right.
It's as simple as that.
Yes. Okay, so the 10th point here is investing in the inevitables. So this is also actually a question, a poll that we actually run in our SIB group. We basically asked whether they would invest in an undervalued company, but the growth is stagnant and it's certain,
Yes.
you know that it's going to be stagnant, or versus very overvalued company, but there's a 50-50 chance that the growth is going to be really attractive. So basically in Buffett's case is that between fast growth and a more certain growth, he always choose the certain one. Yeah, it's just as simple as that. And better undervalue.
Yeah, I think reducing the range of possibilities for the growth profile of the company is very important. right? You can never get it exactly, but if you know that the company grows between, if you can reduce it to something like, this company is going to grow between 10 to 15%, that's very good already. But what you don't want is a situation where will you grow 20 or 50%, or negative and 30%, that's the thing that Buffett doesn't like, which I think makes a lot of sense.
Yes. Okay, the 11th point here is investing in quality. Obviously, if you invest in rubbish companies, you get rubbish return. If you invest in good companies, your returns may not show today, but in the future, it's more likely that it's going to be great. Yeah.
Yes, correct. So this is very important because if you understand the evolution of Warren Buffett, you know that he's a very price-sensitive investor, meaning to say that price matters a lot, right? No matter how good the company. And one of his learning lessons is that the evolution of his investment style is, look, even if, let's say, I think this company has a return on capital of 15%, which means that over time, you'll grow 15%, but today is trading at, let's say, an earnings yield consistent of 12%. It's still worth it to just hop onto the 12% because over time, even though your price paid is a little bit overvalued, you're still going to get returns that are pretty good. And, 15% over time, you're going to get it.
Yeah.
So it's just a question of getting it now or, also you have to ask, like, what if it doesn't drop? Right? So that's really where I think part of the angle of where Buffett's coming from.
Yes. Okay.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, so the 12th point we have here is deep value investing.
Yes.
Okay, so very simple context on it is if you're investing in an ugly business simply because of its price is foolish, and also time is your friend of the wonderful business, the enemy of the mediocre.
So this point needs some context because, in fact, Buffett made his best returns when he was actually investing in mediocre to ugly businesses, but the price was very, very low.
Yeah.
Now, when Buffett starts saying that this kind of investing doesn't work, or in the words here, foolish, is when you have larger sums of capital.
Yeah, this is more of like a net kind of investing.
Yes, net, you're buying less than cash or buying less than working capital. So yeah, I think there needs to be some context with this comment. It is generally true, it's better to buy a wonderful business and time is your friend because if every year it earns 15, 20, 25% on tangible capital, then, obviously it's great versus the company that only earns 2%, 3% or negative. But do note that there are strategies out there where you can do well by investing in ugly businesses. They sometimes call it cigar puff, cigar butt investing, one last puff on the cigar.
Yeah, that you find in a rubbish bin.
Yep, correct.
All right, so 13. First is leverage. I know you guys, those that actually use margins a lot. Basically, his advice is very simple, just don't do it. Even though you're the smartest investor out there, smart investors don't use loans to invest in the stock market.
Well, I would say that I think it was Charlie Munger, his partner, who said, if you are dumb, you should not go near it. If you are smart, you don't need it.
Yes.
That's it.
Yeah, simple as that. Okay, 14, share buybacks. And basically he said that this only makes sense when the company has enough fund to maintain its position. So let's say if they are in a position where they need capital and they need to reinvest back into their business to grow, right? But they use their cash to share buyback. I think he thinks it's a bad strategy. And also when there's also no other way to reinvest at an attractive returns or when the stocks is selling at below intrinsic value. Why this is actually very important is because of I believe Tan Sri Lim Wee Chai, stock love, who actually bought back a lot of stock. Not only actually Tan Sri Lim, even Mark Zuckerberg's Metaverse also.
Yes.
They both bought it at a peak. But the difference is that I believe Meta, they were also spending a lot on R&D.
Yes.
Just to for their Metaverse business. And if let's say they didn't spend that money on share buyback, but instead use it on their R&D or even other stuff, I believe it would be much better.
So the important thing here which needs to be highlighted is that all three conditions must meet before you do a share buyback.
Yes.
So if you look in the case of Top Glove, the big issue was the third one. It was true they didn't need any more money to maintain competitive. They didn't need to reinvest, build a new plant or whatever, right? Because presumably they foresaw ASPs falling. So if ASPs are falling, why invest in another factory, right?
Yeah.
But it wasn't undervalued. That was the thing. That was the issue, right? And so it goes to show that even a business owner who lives and breathes the business don't know exactly how to value a company. And in the case of Meta, I think it was even worse. I think 2 out of the 3 wasn't met, which is the intrinsic value and also nowhere else to reinvest an attractive return. In fact, if you are going so big into the metaverse and you do share buybacks, right, it's very contradictory.
Yes, exactly.
It's a big question mark. But these are the 3 conditions. If it's not met, don't do it.
Yeah. Okay, so the 15th point we have here is not all earnings are created equal. So an asset-heavy business that requires frequent reinvestment to maintain its competitive position doesn't have real earnings. Okay.
Yes.
This is a pretty mouthful and pretty complicated statement that you may want to reread again just to understand what it is about. But basically, every industry's earnings don't really come. Every industry's terms and payments are very different.
Yeah.
Some, for example, like construction, it's not like when you ask people to construct, you get the one lump sum payment of 100 million straight off. It usually comes by stages. So there's like, I believe it's 10 or more than that stages. So that your stage 2A, your piling stage and all the stuff, it's reimbursed like slowly.
Correct.
But if you compare between this and a nasi lemak, nasi lemak, if you sell the product, you straight away get the cash.
Yes.
Yeah. So you need to know that every single business, the profits, cash flow is all not equal.
Yeah, that's right. I mean, every businesses have inflows and outflows, right? Very simply. So the way to make profit is when the inflows are a lot bigger than the outflows are.
Yes.
But in order to get inflows, you actually need outflows, meaning you actually need to spend money.
Yes.
Right? And if the business you're in requires you to constantly spend, not just the same amount, but increasing, you may not know exactly the reason, but you know for a fact that usually you don't have a moat. That's why, again, linking back to number 1, the company doesn't have a moat. That's why it needs to keep pumping in money, right? To get even lower returns. That's one of the worst ones, when you have to spend more to get less.
Yeah. And connecting to commodity business.
Yes. And you might as well quit basically at that point in time. The example also I would give would be something along the line of, even as an individual, right? It's not just about how much you earn, it's how much you can keep.
Yeah.
But at the same time, you can't be like zero expenses, right? You can't be like, inflow and that's it. You actually need to eat. Okay, 1. 2, maybe you need to educate yourself.
Yeah.
3, maybe you need to invest in relationships and things like that. But if you are spending time, or if you are over investing into, I don't know, alcohol and partying and fancy cars and all that, and it puts the ratio of your income and your expenses out of whack, right? Then this is exactly like point number 15.
Yes, exactly. Okay, so the 16th point here is earnings per share is misleading. So when evaluating an acquisition, management often justify it with EPS accretion, but it's actually insignificant. So what really counts is whether this merger is dilutive or anti-dilutive. Okay.
Yeah. There's a word there's a word earlier on called accretion, right? So when mergers and acquisitions, they basically want to know whether it's accretive or dilutive. So accretive means that, it's 1 + 1 = 3.
Okay.
Dilutive means 1 + 1 = 1.5. Okay. So that is really what, if you're going to acquire someone, and if you're only going to get 1 + 1 = 2, right? Just stay where you are, right? It doesn't make any difference. When it comes to the EPS, people like to focus on it because, again, right, it's easy, my earnings per share, then they can compare it with the price, get a P/E ratio and then all things like that. But the ultimate question is not like the EPS. It's when you push this thing together, can it make magic? Can it produce more? And very often it doesn't. Very, very often it doesn't when it comes to M&A.
Yes. Okay, the last point, finally, and it's about inflation. So, asset-like companies that have pricing power will benefit from inflation. I think that makes
it's
a lot
by
of sense.
definition. If you
Yeah,
have pricing
it is.
power, it means.
Yes, and on the other hand, if companies that have to invest in a lot of these PPEs to stay relevant, right, you definitely suffer in periods of high inflation. Yeah, I believe this is very true. Again, the same example, which is Glove. They
Yes.
spend a lot of money on PPE, and right now we are in a high inflation environment. They're also kind of suffering. I
Yep.
mean, you can tell from the numbers, right, latest financials, not only because of revenue, because of competition, but also because of cost also.
Yes.
The fixed cost and variable cost has been increasing. So double whammy effect that hampered out their profitability. So yeah, that is a practical example. Anything you want to add on for this point?
I think that some comments needs to be put in place, because let's say it is not wrong to invest or build a company where you have to spend money to stay relevant in terms of equipment and all that.
Yeah.
The question also you need to think of is not like what you spend on, is what is your market. So like in Glove's case, the spending on the equipment and all that, they have to do it to stay relevant. It's not wrong to stay relevant. But the issue is the fact that the price of their things that they sell are volatile, and in this case it's dropping a lot. Because it wouldn't be a problem if the price of the product is increasing.
Yes.
So it's really a twofold thing, right? You may be acquiring goods or buying stuff for your PP&E that experiences inflation. But if what you're selling is contributing to inflation also,
yes,
then it doesn't really matter.
Yeah.
Right? If you're selling candy, right, the sugar goes up, it doesn't matter. Mr. So-and-so.
Pump the money.
Yes.
10%, 30%. Yeah.
So that is something people need to think about also, is like, who are your customers? What's the demand profile like? So once you figure that out, and this is more business really, like once you figure that out, then spending all this money on PP&E is really an afterthought, because you're like, yeah, the inflow is really big, so I'm just going to spend to maintain the inflow. That's it.
Yes, exactly. I mean, a very straightforward example also is Apple. The iPhone the price has been increasing every single year.
Yeah.
So yeah, that's it for the summary of Warren Buffett's Berkshire Hathaway's newsletter by Thomas Tra. Thank you so much again, Thomas Tra. And before you guys go, this is FIRL Pro's stock performance for January 2023. I believe one of the stock A is now 2x already, finally.
Yes.
Yeah.
February, we will announce the result.
Yes, correct. And basically what FIRL Pro is, we giving...
There may be a second stock that will 2x also.
Yeah.
Okay.
And also hint, it's not a Malaysian stock.
Yeah, it's not Malaysian stock.
It's not a Malaysian stock. Yeah. So if you don't know what FIRL Pro is, it's basically a program that can cut short your research by 90 or 80 to 90% of your time. And we are going to be sharing you guys our analysis and reports on the companies that we have high conviction on. Basically, every single month, we're going to be giving you minimum 2 stock reports and also one big picture report for every 2 months, basically telling you where the economy is heading. And if you want more information about FIRL Pro, and you don't want to pay for it at the moment, don't worry, we got a free sample for you, showing you guys how we write our stock reports, how we write our big picture reports, and also one of the video from our SIB program. You can get the links in the description and comments.
Yeah, if you have any questions, just send us an email. You can find our email in the description as well.
Yes.
And guys, thank you for staying all the way until the end. Looking forward to seeing you in the next video. Peace.